All right, stop scrolling for a second because something just broke in silver, and it didn't happen slowly. I'm talking about roughly 30% vanished in days, not months. Western prices collapsing from about $121 an ounce down to the mid-80s. And here's what should make your eyes widen. At the exact same time, Shanghai silver barely blinked. It's holding near 122 right now. That's a 40+% physical premium. Think about that. If this was a demand collapse, if industrial users suddenly stopped buying, if the solar industry went dark overnight, Shanghai wouldn't be sitting there calmly paying 40% more than New York. That doesn't scream demand collapse. That screams stress in the plumbing. The real trigger isn't what the headlines are saying, and both Western futures data and Asian physical pricing just confirmed it. Stay with me, because if you understand what's happening in this window, you'll recognize it the next time before the headlines catch up. And if you're holding silver right now, or if you've been waiting for an entry, your job is to understand the mechanics behind this move. Not the narratives, the mechanics. Before I explain what caused this collapse, let me teach you something most people miss about silver. Silver doesn't behave like gold. It's thinner, more leveraged, more emotional. The gold market is like a wide highway with multiple lanes. Traffic moves, sure, but there's room to maneuver. Silver is different. Silver is a two-lane country road with ditches on both sides. When it runs too far. When it breaks violently. Think of it like a crowded theater with one narrow exit. As long as everyone's calm, it works fine. People file out in an orderly way. But the second panic hits, the second someone yells fire, prices don't move one step at a time. They lurch, they stampede. And that's because silver markets are dominated by leverage. Futures contracts, options on futures, leveraged ETFs, borrowed money betting on borrowed positions. So when you see silver go parabolic, when you see it climbing 5, 10, 15% in a week, you should already be asking yourself a critical question. Who's leveraged, who's borrowed, and who's going to be forced to sell if this turns even slightly? That's not pessimism, that's pattern recognition. Because in leverage markets, the moves that matter aren't the ones driven by new information. They're the ones driven by forced liquidation. And forced liquidation doesn't care about your thesis. It doesn't care about supply deficits or industrial demand or monetary policy. It cares about one thing: cash. So, when you understand that silver is structurally vulnerable to these cascades, you're not surprised when they happen. You're watching for the setup. That's the lesson you can reuse, not just in silver, in any thin leverage market. And if this is making sense so far, drop a comment below and let me know if you've seen this pattern before, because I want to hear your stories. Now here's what's actually happening right now. Let me break down the sequence step by step, because this isn't complicated once you see the chain reaction. Silver had a parabolic paper market run. Futures, options, leverage on top of leverage. That pushed Western prices north of $120 in a hurry. Everyone's piling in. Momentum traders, retail accounts, even some institutional players chasing the move. And then something shifted. Volatility spiked. When volatility spikes in futures markets, exchanges do something automatic. They raise margins. Margin requirements are the cash you have to post to hold a leverage position. When markets get wild, exchanges increase those requirements to protect themselves. And when that happens, traders don't get a choice. They get a call, they either post more cash immediately or they sell. There's no third option. So selling starts, and here's the key. That selling doesn't start because someone discovered a massive new silver mine. It doesn't start because solar panel manufacturers suddenly stopped buying. It starts because positions have to be reduced. It's mechanical. It's forced. And that selling pushes the price down, which triggers more margin calls, which forces more selling. That's the cascade. Once it starts, it feeds on itself. Price drops trigger liquidation. Liquidation drops price. And the cycle accelerates until either the selling exhausts itself or the market finds buyers willing to step in front of it. Now here's what makes this situation so telling. While that paper liquidation was hammering Western prices down toward 85, physical silver in Shanghai stayed bid, barely moving, sitting near 122. Let that sink in for a second. The paper market, the futures market, the leveraged derivative market in New York and London, that's saying panic. Sell everything. Get out. But the physical market in Shanghai, where actual metal changes hands, where refiners and industrial users and dealers trade real bars, that market is saying something completely different. It's saying tight. It's saying we still need this metal. And when those two disagree this violently, when you see a 40% divergence between paper and physical, you're not in a normal market anymore. You're in price discovery. But here's the part that should make you nervous. Price discovery cuts both ways. If forced selling isn't done, if there are more leverage positions that haven't been liquidated yet, it doesn't care about your conviction. It doesn't care that Shanghai premiums are elevated. It'll keep grinding lower until the mechanical pressure stops. This is the exact same playbook we've seen before, and I want to walk you through the history here because the pattern is consistent. In 2008, during the financial crisis, silver didn't politely drift lower. It crashed hard, lost more than half its value in a matter of weeks, went from near $21 down to under $9. And the narrative at the time was financial apocalypse, everything's collapsing, industrial demand is dead. But then what happened? Once the liquidation ran its course, once the forced selling exhausted itself, silver ripped higher. It didn't take years, it took months. Because the forced sellers were gone and the physical buyers were still there. In 2011, after silver's blow-off top near $50, it collapsed in waves. Violent drops followed by sharp rebounds, then more drops, then more rebounds, before finally finding a base in the high 20s. Same story. Leverage longs getting flushed out. Margin calls. Cascade selling, and each time it looked like the bottom, another wave would hit. In March 2020, during the global liquidity scramble, silver got obliterated, dropped to near $12 while gold was holding relatively firm. And at the same time, physical premiums exploded. You couldn't buy silver eagles or bars at spot price. Dealers were charging $4, $5, $6 over spot because metal couldn't be sourced. The paper market said worthless. The physical market said priceless. Every single time this has happened, the common thread wasn't new supply flooding the market. It wasn't collapsing end demand. It was forced deleveraging. Zoom out and you see the pattern clear as day. First comes leverage. Everyone piling in on borrowed money. Then comes the margin call. Exchanges raise requirements. Then comes the flush. Positions get liquidated regardless of fundamentals. What comes next depends on whether the flush actually finishes or whether there's another layer waiting to crack. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep going lower? Absolutely. Silver can overshoot on the downside just as brutally as it overshoots on the upside. There's no law that says 85 is the floor. Could we see 75? Could we see 70? Yeah, we could. If there's another wave of forced liquidation, if leverage positions are still out there waiting to be unwound, the market will find them, and it won't be gentle about it. Could manipulation narratives explain everything? Here's my honest take. Blaming everything on manipulation doesn't help you make decisions. Does concentrated short positioning exist? Yes. Do large banks have interests that don't align with retail longs? Obviously. But focusing on that doesn't give you actionable information. It just makes you angry. Markets are mechanical systems under stress. Focus on what you can control and observe. Volatility, price levels, price, physical premiums, order flow. Those things you can track. Those things tell you what's happening in real time. Could this be a structural shift where silver never recovers? I doubt it, but let's be honest about the bear case. If industrial demand actually collapses, if solar installations crater, if electric vehicle production stalls, if the physical users genuinely don't need this metal anymore, then, yeah, lower prices make sense. But that's not what the Shanghai premium is telling us. If liquidation resumes, deeper levels like 70 to 75 come into play. And yes, that's where some big banks' scary $50 risk scenarios start sounding less crazy. Ignoring that possibility doesn't make you smarter. It makes you blind. So I'm not sitting here pretending this can't get worse. I'm saying the evidence right now points to mechanics, not fundamentals. There are probably 3 types of people watching this right now. The first is already long silver and feels sick. Maybe you bought at 110. Maybe you bought at 115. Maybe you're sitting on physical and watching the value melt. If that's you, I get it. This hurts. But your job right now isn't to doom scroll headlines. Your job isn't to panic, sell into the liquidation. Your job is to watch stabilization signals. Does volatility cool off? Does the VIX for silver futures start declining? Does price hold 80 to 85 instead of knifing through it? Do Shanghai premiums stay elevated above 115? Those are your tells. If price stabilizes here and volatility drops, that's your first sign. The forced selling is exhausting. If Shanghai keeps paying huge premiums, that's confirming the physical market hasn't broken. You need patience right now, not blind hope, informed patience. Watch the data. The second type of person watching this is sitting in cash, waiting for blood in the streets. You've been watching silver run and you didn't chase it. Smart. You're waiting for the panic to give you an entry. That's valid. But patience matters here too. Catching a falling knife feels heroic until it isn't. Until you buy at 85 and watch it go to 75. Let the market prove exhaustion before you size in. What does that look like? Stabilization. A few days where price doesn't make new lows. Volume starting to decline. Volatility compressing. Shanghai premiums holding or expanding. You don't need to catch the exact bottom. You need to catch the turn. And the turn shows itself through confirmation, not guesswork. The third type already sold or shorted and thinks the party's over. Maybe you got out at 100. Maybe you're short from 110. Maybe you think silver's going to 50. You might be right, but remember, silver reversals are violent too. If this was purely mechanical liquidation, the snapback can be just as fast as the drop. So, don't get complacent. Watch for signs that the selling is done, because if you're short and the forced sellers exhaust, you're the next one who might be getting squeezed. The universal principle for all of you, regardless of where you stand, is this. Don't trade narratives. Trade confirmation. The narrative says silver's dead, or silver's manipulated, or silver's going to the moon. The confirmation says price is stabilizing, or price is breaking down, or physical premiums are widening. Trade what you can see, not what you believe. So here's where I stand, and I'm going to be transparent with you. I'm not backing up the truck blindly. I'm not going all in at 85 and hoping for the best. And I'm not running away either. I'm not declaring silver dead and moving on. I'm watching three things very closely. First, that 80 to 85 zone as a near-term floor. If price holds here for a few days, if we get some consolidation instead of another leg down, that tells me the first wave of forced selling might be done. It doesn't mean we've bottomed for good. It just means the immediate mechanical pressure is easing. Second, whether a deeper washout towards 70 to 75 even materializes or fails to show up. If we get another spike in volatility and another round of margin calls, I want to see if there's enough left to push us into the sevens or if buyers step in first. That's critical information. Because if buyers absorb the selling at 85, that's a different market than one that waterfalls to 70. Third, Shanghai. I'm watching Shanghai's silver like a hawk. As long as Shanghai stays north of roughly 115, as long as that physical premium stays wide, physical demand is speaking louder than future screens. That tells me this isn't a fundamental collapse. It's a paper market event, and paper market events end when the paper gets flushed. Based on my analysis, this move was mechanical, not fundamental. It was a leverage event, not a demand collapse. The fundamental picture for silver hasn't changed in the last week. Solar demand is still growing. Electric vehicle production is still ramping. Electronics manufacturing is still consuming silver. Industrial users still need this metal. What changed was leverage. What changed was margin requirements. What changed was forced liquidation. And if history rhymes, if this follows the pattern we've seen in 2008, 2011, and 2020, the end of forced selling won't feel calm. It'll feel confusing. It'll feel like maybe it's going lower, and then it'll reverse. And the move that follows could be violent in the other direction. I'm not predicting that. I'm saying that's what the historical pattern shows. I'm not a financial advisor. This is not financial advice. Do your own research, verify everything I've said. Look at the Shanghai premiums yourself. Look at the historical precedents yourself. Make your own decisions based on your own risk tolerance and your own timeline. If you made it this far, you're doing the work that most people won't do. You're not just reacting to headlines. You're not just following hype. You're trying to understand the mechanics. That mentality will serve you well. Not just in silver, in every market you touch. Because markets are systems. They're not random. They're not pure chaos. They follow patterns. Leverage creates vulnerability. Volatility triggers liquidation. Liquidation creates opportunity. And the people who understand that, the people who can watch the divergence between paper and physical and know what it means, those are the people who don't get caught on the wrong side. So, if this helped you see the situation more clearly, share this video. Send it to someone who's panicking about silver right now. Send it to someone who's trying to figure out if this is a buying opportunity. And subscribe if you want more of this kind of breakdown, because I'm going to keep tracking this situation, and I'm going to keep showing you what I'm watching. Think critically, verify your data, and make your own decisions. Stay sharp out there.